This is John Campbell. Welcome to Economics 1723 Capital Markets. This is the online module for Lecture 21. And we're going to be talking about option pricing today. We're going to be covering influences on option value, looking at that with the help of the put-call parity theorem. Then we're going to talk about implicit derivatives, which show up naturally in many financial situations. And finally, we're going to do an introduction to binomial option pricing. So let's recall the elements of the put-call parity formula. I've written the formula up here on the left. It says that the price of a call plus the discounted exercise price has to equal the price of the stock plus the price of a put. And that's because call plus cash equals stock plus put in terms of final payoff. Now, in this table, I'm showing you qualitative statements about the influences on option values of the elements in the rows. Here we have X, X, RF, and D. D for dividend, and the two columns are call value and put value. Now, the basic idea of the table is to show you that variables which appear in the put-call parity formula, I'll get to dividend in a minute, that's missing from here, but things that appear in the put-call parity formula affect option value in the natural way. So what do I mean by the natural way? Well, take a look at the stock price. It appears on the right-hand side of this equation. And so if it goes up, then either call value must increase or put value must decrease, or both, because of course the discounted exercise price is fixed. So an increase in S on the right-hand side has to correspond to some combination of an increase in C and a decrease in P. What the table shows you is that in fact both happen. The call value goes up, the put value goes down. The next row looks at X, the exercise price. You notice that it appears on the left of the equation, so the above logic is reversed, and an increase in X has to do some combination of lowering the price of the call, increasing the price of the put, and in fact it does both. The call price declines, the put price goes up. Let's take a look at RF. Where does RF, the risk-free rate, appear in the formula? Well, it discounts the exercise price. So when RF goes up, the discounted exercise price on the left-hand side of the equation declines. And that means that there must be some combination of an increase in call value and a decrease in put value. Again, the table shows that both happen. The call price goes up, the put price goes down. Now finally here we have D, that's the dividend. That's missing from this version of the equation, but if you remember, for a stock that's paying a dividend, you have to add the discounted dividend on the left-hand side of the equation, and thus it acts like the exercise price. It appears on the left in the same way, and so the same point applies for D, that in fact when the dividend goes up, the call price goes down and the put price goes up. Now I've drawn a line below here because these are in fact the variables which can move unambiguously calls and puts in opposite directions. Now think about other influences on option valuation. I'm going to leave T, the maturity date, to one side for a moment. You notice that it does actually appear here in the formula discounting. But we're going to leave that to one side for the moment. But let's talk about anything else, any other variable. For example, volatility. Let's talk about volatility. How does that affect call and put prices? Well, what I want you to observe is by looking at the formula, since volatility isn't explicitly in here, anything that increases call value must also increase put value, because this always has to hold. So if call value goes up, put value must also go up if we're fixing S, X, RF, and T. Well, in fact, as we'll see on the next slide, what volatility does is it increases both these elements. Okay, so volatility increases call prices and put prices. So put-call parity tells you that the effect must be the same on the two, but what we actually know is that, in fact, it's a positive effect. Now, what's the intuition for that positive effect of volatility on option value? It's that an option is a one-sided bet. It has full upside participation if the asset goes your way, up in the case of a call, down in the case of a put. But the downside exposure, if things go against you, if you've bought an option, is limited to the price of the option. So it's a limited liability asset. The worst that can happen is that the option expires worthless and you walk away. So the reason that volatility increases option value for both puts and calls is that it increases the upside more than the downside. The volatility effect on the underlying security price is symmetrical, but for the option holder, it's a one-sided bet, so you win more when you win than you lose when you lose. What this also means is that in financial situations where option holders can influence volatility, they actually have an incentive to increase it. Why? Because increasing volatility will increase the value of the options that they own. Now finally, let me just go back here to this time to maturity point. If you look at time to maturity, it appears in the same way that RF does, and you might think that it would therefore unambiguously operate like RF, increasing the call price, lowering the put price. It turns out that because time to maturity also gives more time for uncertainty to operate, that there's the direct time value of money effect here, but then it also operates a little bit like an increase in volatility because it gives more time for uncertainty to be realized. And so in the case of the call, both the direct effect and the indirect effect are positive, so we know that time to maturity increases call value. However, it's ambiguous in the case of a put, so I'm going to put a question mark here in the case of the put. Okay, let's go on to the second topic, which is implicit derivatives. The point I want to make is that options naturally emerge in a number of financial settings. Once you learn to see them, they pop out everywhere, and they're really very important. Now, we're going to review one of the most obvious settings before we continue with pricing. I'll do more in the lecture, but for now I'll just talk to you about risky debt and the accompanying issue of risk shifting. So consider a corporation that issues debt with face value D. Now, the corporation promises to pay D, but if it can't fulfill that promise, it enters bankruptcy, and the debt holders take over the firm. That's a consequence of limited liability for the stockholders. The most stockholders can lose is their initial investment. So bankruptcy is the situation where the stockholders lose what they put in. They lose all the value of their shares. The debt holders also lose. They don't get the full value of their debt promised payment D, but in partial compensation, they take over the firm. Now let's denote the firm's total value by V for value, and capital T is the terminal date when the debt is due. If V at that time T is bigger than D, bigger than or equal to D, the debt holders get D and the stockholders get VT minus D. On the other hand, if VT is strictly less than D, then the firm is bankrupt, the debt holders get V, and the stockholders get nothing. So one can actually draw the payoff diagrams to the debt holders and the stockholders like this. The debt payoff is the red line. If the value of the firm on the horizontal axis exceeds D, then the debt holders get D, the promised amount. It's a flat line. But below D, they get the 45-degree line because they're getting all the value in the firm. The stockholders, on the other hand, get nothing if the final value of the firm is D, and then above D, it's a 45-degree line. This way of thinking about corporate finance is known as contingent claim analysis, and hopefully you can see from these payoff diagrams that, in fact, debt holders and equity holders, when there's this risky debt, they implicitly have options. So what are the options? Well, there's two ways to think about it. The first is we can think of the stockholders as owning the firm, having sold, owing safe debt D, but also owning a put option to sell the firm to debt holders at an exercise price D. So the risky debt is equivalent to safe debt plus a put option that the stockholders have, that if the firm is worth less than D, they can sell the firm to debt holders at an exercise price D. So bondholders have bought the safe debt D and have written the put option. And of course, stockholders will exercise the option if the terminal value of the firm, VT, is less than D. So that's one way to think about it. Alternatively, we can think about it this way. We can think of the stockholders as actually not owning the firm at all, but owning a call option on the firm with an exercise price D. Bondholders have bought the firm implicitly in this other way of thinking about it and have written the call option. So then stockholders exercise the option if VT is bigger than D. Now, by put-call parity, these two ways of thinking about the problem are equivalent, because the first way says that stockholders have the value of the firm minus the discounted value of the safe debt plus the value of the put option that they own to default. And that, by put-call parity, has to be equal to, on the right-hand side, the value of a call on the firm. If we go back for a moment to the payoff diagram, you can see that the payoff to the stockholders, the blue line, is just the payoff on a call option. All right, and then what the bondholders have is the residual, the value of the total stock less the value of the call option that the equity holders have. So this red line is, you can think of it as the value of the stock less the value of the call, which the equity holders have. That's one way to think of it. Or you can think of it as safe debt less the value of the put that the equity holders have written to that the debt holders have written to the equity holders. Okay, so this is the contingent claims analysis of risky debt. Now, what does this imply for incentives? Since the stockholders own an option, right? With either way of thinking about it, the stockholders own an option. On the left here, we think of them as owning a put, along with some other stuff. On the right, we think of them as owning a call. But either way, they own an option. And so they benefit from increases in volatility of the firm's returns. Debt holders, on the other hand, lose from volatility. If you're a creditor, you don't want the firm you've lent to take a lot of risk. So often, firms that borrow must sign covenants with bondholders that limit their ability to undertake new risky activities. The stockholders' incentive to engage in risk-taking is known as risk shifting, because when they take risk, they put some of the cost of that onto the bondholders. Same issue arises with executive compensation. Many company employees are granted options on the stock of their company. These options give executives an incentive to increase the value of the company, which is good for shareholders. They also give executives an incentive to increase the riskiness of the firm's projects. Why? Because the executives are option holders, so they'll win more on the upside than they lose on the downside. Now, is this desirable for shareholders? Well, that depends. On the one hand, the executives of the company may have a lot of their human capital tied up in this company, and so they have some undiversifiable risk. They may be too cautious in the absence of this incentive. On the other hand, the incentive may go too far and may lead executives to take too much risk. So taking a broader perspective, there's a so-called moral hazard view of the global financial crisis, which began with risky subprime lending in mortgages. And that view is that stockholders' incentives to take risk, shifting risk to creditors, and traders' incentives to take risk through executive compensation led large financial firms to lend in very risky ways. And furthermore, this was amplified by implicit government protection, which is a theme we'll get to later. Okay, so the third topic for this module is binomial option pricing. And what I want to do is show you how you can use a binomial tree, which is a diagram for different possible paths of the stock price, to figure out the value of an option. This is very useful, very popular. It can be made much more complicated than what I'll show you, more complicated but also more realistic. However, I'll just show you a single period, two-state example, and then sketch out the generalization to multiple periods and more states. So here's a two-state example. Consider a stock that sells for $100 today and in 1 year will be worth either $200 or $50. So down here at the bottom, here's the stock, 100 today, either 200 or 50 a year from now. Also consider a 1-year call option on the stock, which has an exercise price of 125. In 1 year, it will either be worth 75, which is 200 minus 125 equals 75, or it'll be worth 0, because if the stock is worth only 50, the option will be out of the money and you will walk away. It'll be worth 0. So here are the payoffs on the call, 75 or 0. We want to know what the call is worth today. And the trick is to figure out how to combine stock and cash or borrowing to replicate the option, which means get the same payoff in a year as the option will give you. Now, we'll work through this in detail in class, but I just want you to look at the diagrams and observe that a first move might be to look at the spread between the good state and the bad state, the up and the down. For the case of the stock, that's 150 spread. Over here, for the case of the option, we've got a spread of only 75. Well, 75 is 1/2 of 150, which means that if you own 1/2 share of stock, you're going to get the same difference between the up state and the down state as you do for the call. Now, 1/2 share of stock, on the other hand, gives you 25 in the down state and 100 in the up state. So we need to shift that down by $25. We need to shift those payoffs down by $25 in order to make them the same as the call. How do we do that? Well, we borrow an amount of money today such that in a year we have to repay $25. Okay, so that will, then the repayment of the $25 will shift the payoff here to 0 and 75, and it'll be equivalent to the call. So depending on the interest rate, then we calculate how much money we borrow today in order to repay 25 in a year, and the value of the call must be the value of the stock less the value of that amount borrowed, the discounted value of 25. Now, that little analysis involved the riskless interest rate, right? And it involved those tree diagrams, but I never used the probabilities of the up and down states. If you look back here, I didn't label the probabilities here. But it's the probabilities that determine the expected return on the stock. So I've just shown you that the call value does not depend on the expected stock return. The stock price and the riskless rate capture all the information relevant to value the option. Now, we could flip back actually to the diagram here and observe that if the riskless rate were to influence option value, if the expected return on the stock were to influence option value, it would have to influence call and put value the same way. One's naive intuition is that the expected return on the stock would increase the call price and lower the put price, but you can see from here that that can't be right, because in order to raise the call, it would have to raise the put. So in fact, the expected return on the stock is irrelevant. It doesn't influence either of these things. So we'll discuss that more in class as well. So now I'm coming back to the binomial model, and I want to give you a more general way of doing the calculation. So think more generally. Suppose the stock starts at price S0 and can move either to SU or SD, that's up or down. The call option will be worth CU or CD as a result. Well then, to replicate the option, what you do is you hold H units of stock and bills with par value B, which can be negative, which would mean borrowing, where H times SU plus B has to equal CU. In other words, the value of the stock plus bills or borrowing in the good state is the good state value of the call. And then in the bad state, we have HSD plus B equals CD. So again, in the down state, the value of this portfolio equals the value of the call. So you solve these. You've got two equations here and two unknowns. We solve for H and B. As I said, for a call option, B is going to be negative and H will be positive. And then once you've found H and B, you solve for the option price as the H times the price of the share today plus B discounted. So that's the general recipe for solving a two-state, one-period binomial option pricing model. And notice again that the risk-free rate comes in here, but nowhere in here do we see the expected return on the stock. Well, how do we find CU and CD, which are the next period call values? In a one-period problem where the option is about to expire, we would use the option value at maturity, but more generally we can work backwards through time. Over many periods, we have what's called a binomial tree, and we work backward through the tree, and if necessary, we can take into account the possibility of early exercise for an American option, which might be relevant if there are dividends or if it's a put option. So here's a 2-period tree. We start, the stock is worth 0 initially. It can go up or down, and then it can go up twice, or up and then down, or this here should say SDD. This should be down twice. Okay, so this is what's called a recombining tree, because up and then down is the same as down and then up. So after 2 periods, we have 3 states. So finally, when you solve the replication equation, which was a couple of slides ago, this equation, when you solve this equation, what you're going to find is that H is the change in the option price between the up and the down state divided by the change in the stock price between the up and the down state. So in the example, this was 75 on the top, and this was 150 on the bottom. 75 divided by 150 is 1/2. This H is known as the hedge ratio, and it's the number of stocks needed to hedge the risk of writing one option. Or equivalently, it's the number of shares of stock you need to hold to replicate the behavior of an option. This is another word for this is delta. Option analysis often uses the names of Greek letters, so in this case delta. And the option's delta is the change of the option price in response to a small change in the price of the stock. And we're going to come back to this ratio in the next lecture. Thank you.